Inflation just hit its highest level in 3 years. Yeah, I know, it's not the news anyone wanted. But the story behind our housing costs, well, it is actually way more complicated than a single headline might make you think. Welcome to This Explainer, where we're going to dive into the housing inflation paradox.
Think about this for a second. Official government rent data is basically screaming that housing costs are rapidly heating up again. Yet, if you look at real-time apartment markets across the country, they're showing the exact opposite. We are looking at the exact same economy, right? But it's sending out two completely different signals. That contradiction is where the story gets really fascinating. And it's something that affects everyday decisions for all of us, from our household budgets to whether you decide to sign a new lease or apply for a mortgage. So, which reality is actually true? Let's untangle the math. We're looking at a pretty stark contradiction. The official consumer price index shows what looks like a shelter surge, a 0.6% monthly acceleration in April 2026. Now, this was a clear reversal of the moderating trends we were seeing earlier in the year. But on the flip side, real-time asking rents from private data tell a totally different story, a 1.7% yearly decline. So you've got to wonder, how exactly can rents be surging and falling at exactly the same time?
To understand this, we actually have to look backward. That sudden jump in the official government shelter metric, it isn't an organic tightening of the rental market at all. It's actually a statistical ghost. Seriously, it's a lingering effect from the federal government shutdown that happened back in October 2025. The math behind how the Bureau of Labor Statistics actually tracks your rent is kind of fascinating. They use what's called a biannual panel structure. Basically, that means they survey a specific physical rental unit exactly once every 6 months. Because the October 2025 survey was suspended during that government shutdown, the BLS had to use older data just as a placeholder. So when they finally went back to resurvey those exact same units in April 2026, boom, they suddenly had to account for a full 12 months of rental price changes all at once. This created a weird phenomenon known as mechanical double counting. Instead of tracking a smooth, natural curve, they captured a full year of rent adjustments, but mathematically recorded the entire change as if it happened within just a 6-month window. This glitch artificially inflated the April 2026 numbers and fundamentally distorted the mathematical reality of what renters are actually experiencing right now. Let's just pause on that thought for a second. Sometimes the most important economic story isn't the number itself, it's what the number is actually measuring. Government inflation measures capture a very broad, slow-moving picture. They include existing long-term leases that might have been signed well over a year ago. Private listing data, on the other hand, reflects the immediate reality. It shows exactly what a new renter sees when they look for an apartment today. And you know what? That immediate reality is actually remarkably soft. Leading private sector indicators from places like Realtor.com and Apartment List reveal a highly renter-favorable market. Get this, we are currently in the 33rd consecutive month of annual contraction for units with 0 to 2 bedrooms. Prices are steadily cooling off, rents still remain $92 below their historic peak from the summer of 2022, and apartments are sitting on the market for an average of 38 days, which is the longest duration we've seen since 2019. So why the softness? Well, it comes down to basic supply and demand. We recently witnessed a massive, historic wave of new apartment construction, a true building boom. In 2024, the market absorbed 600,000 new units, the highest addition of supply since 1986, and that was followed by another 500,000 units in 2025. This incredible wave of construction pushed the national vacancy rate up to 8.5%. It essentially took pricing power right away from landlords and handed the leverage firmly back to tenants. But keep in mind, this relief is incredibly uneven depending on where you live. Unmitigated construction in Sunbelt cities has caused rents to absolutely plunge. Look at Austin, Texas, down 5.3% year over year and down 20% from its peak just due to sheer oversupply. San Antonio is dealing with a severe 16.1% vacancy rate. But if you flip to constrained coastal markets like San Francisco, they are seeing costs surge by 7.6% amidst a tech-led demand recovery. The national housing market isn't just one big market. It's a collection of highly localized, distinct realities. Now, why does this matter for the rest of us? Well, this isn't just some quirk for apartment hunters. This localized ADA disconnect creates a massive headache for the broader economy. Because policymakers don't set interest rates based on the real-time private market in Austin or Chicago. No, they set national policy based on the official, slow-moving, structurally distorted government numbers. and that immense challenge falls squarely on the newly confirmed Federal Reserve Chair Kevin Warsh. Chair Warsh is stepping into an incredibly restrictive environment. The federal funds rate sits between 3.50% and 3.75% right now. The administration has advocated for aggressive rate cuts, sure, but the artificially hot official shelter data, combined with a broader energy price shock, has effectively closed the door on any near-term monetary easing. In fact, there is currently a 97% probability that rates will remain totally unchanged at their next policy meeting. Warsh has also indicated a philosophy of keeping the central bank's balance sheet smaller and tolerating more natural market volatility. Mathematically, the Fed is essentially boxed in, constrained to keep interest rates higher for longer. So here is the absolute crucial point. How does this high-level monetary policy translate directly into the homebuyer's reality? Well, because of those stubbornly high official inflation prints, the average 30-year fixed-rate mortgage recently surged to 6.57%. This right here is the direct mechanism where an abstract data glitch on a government spreadsheet suddenly becomes a very real, very heavy financial barrier for a family just trying to buy a home. These elevated borrowing costs have kept the broader housing market in a complete deep freeze. Affordability remains severely squeezed. While it technically remains a buyer's market with 46.5% more active sellers than buyers out there, that gap is beginning to narrow. A surprisingly resilient job market is slowly drawn marginal house hunters back into the fold, especially in regions outside the heavily oversupplied South. Ultimately, the ongoing challenge for the Fed really boils down to the structural formula used for these metrics. Because the official index has to capture rent adjustments for both brand new leases and long-term renewing tenants, it naturally lags. Even as new listing prices soften out in the real world, the incredibly slow adjustment of existing tenant leases will continue to provide a persistent source of friction for the Federal Reserve. This whole situation leaves us with two competing, yet completely reasonable interpretations of the exact same economy. Interpretation 1 suggests that inflation is simply stubborn, price increases are bleeding into core services, and that totally justifies keeping interest rates elevated. But Interpretation 2, it argues that today's official housing inflation numbers are merely lagging indicators, moving at a snail's pace, and that the softer real-time rental trends we see on the ground today will eventually show up in future government data. So what happens next? If we look ahead, analysts are really watching for one realistic scenario, a steady process of statistical normalization. Step by step, over the next several quarters, the anomalous data from the October 2025 government shutdown could gradually roll off the annual calculations. If that happens, the official shelter metrics may slowly return to their underlying run rates of about 0.2 to 0.3% a month. Eventually, the official CPI could finally align with the softer, real-time private market reality. But until that data normalization actually happens, we're living in a dual reality. Renter relief remains statistically elusive in the official government indicators that dictate national interest rates, which keeps the broader housing market totally frozen. And yet, that exact same relief has already materialized as a tangible, real-world reality for tenants who are out there navigating the actual real-time asking market today. The numbers on paper and the reality on the street are literally moving at completely different speeds. So I want you to think about your own neighborhood for a second. Is the government's math actually matching your reality, or are housing costs telling a completely different story right outside your door?
An investment in knowledge pays the best interest, so why not invest in this channel? Click like and subscribe for more.